Hello, hey, it's Nick, Supix Century 21 Real Estate. Going to go over some key terms for home buyers, what they should know when they get into the marketplace and people start talking about things. Number one, I'm going to get right into it, affordability. Affordability, after the last few years with prices going up, but rates were low, so it was affordable. So things were affordable. Now, with prices still escalating and interest rates, well, at least they've topped out, so maybe affordability is coming back. They talk about wages going up some, so hopefully that means affordability is coming back. I believe the marketplace is going to be more favorable to home buyers in the next few months. And I think if I was a home buyer, I'd really be looking at late summer right now, hopefully. But rates will probably be up a little bit at that point. So, it's always that little give or take. And so let's see, the appraisal. So appraisal, why you have to have an appraisal done? Only if you're getting a mortgage. If you pay cash, you can still have an appraisal done. You can have it contingent on an appraisal, but you don't have to. So there's different types of appraisals. There's an FHA appraisal, a VA appraisal, like a conventional loan appraisal. And even from there, they have drive-by appraisals, they have desk appraisals. FHA and VA are very similar. They're going to look a little more at the house, a little more, and make sure that it's moving condition and ready to go. And there's certain characteristics they're going to look at. Let's see, closing costs. What is closing costs? Like people, hey, pay my closing costs. What are you talking about? What specifically are you talking about? There's the cost of the appraisal. There's taxes, and when we say taxes, it's property taxes. And then there's also transfer taxes. Transfer taxes most of the time is 2%, one state, one local. Parts of Pittsburgh can be upwards of 5%, where it's still only one to the state, and then but the local likes to take additional funds. And there's some different areas that it may veer from the standard 2%, where it can be 2.5, 3, and like I said, Pittsburgh's 4, or I think it's 5 right now. But title insurance, title searches, that's typically buyer expense. And let's see, escrow, setting up an escrow account in your when you're doing a mortgage. There's setting up an escrow account, which is funding your future taxes, future insurance costs. There's agent fees. There's loan costs in general. Like there can be some loan doc fees, and that's primarily it. Sometimes there's a mortgage insurance fee you can pay up front. Let's go. Credit score. So what's credit score? There's 3 major companies that do report credits, Equifax, Experian, and TransUnion. Lenders are going to use that to more or less kind of qualify you for a loan. They're going to look at the credit score. They do adjust those rates over time, like what's acceptable, what's not acceptable over the years. I think at one point some time ago you could go as low as like 550, but right now it's typically somewhere over 600, 625 is going to get you into an FHA loan. If you start getting upper 6s into 700s, you're commonly going to approve for a conventional loan. And so that's the main reason for a credit score. And then we talked about closing costs, but now down payment. So every loan has different types of down payment. So I like to just use round numbers. So if you're spending $100 grand and there's a down payment, if it's an FHA loan, they're going to require you to have 3.5%. So on $100,000, that's $3,500. That's your down payment. That's not your closing cost. That's your down payment. You put those together, that is then you're like clear to go. Your cash to close number, your down payment and your closing costs together. So if you do a conventional loan, you can do a 5%. There's 3% down conventional loans. There's 5% conventional loans, 10%, 20%. 20% is kind of like the magic number, because anything under 20%, you're going to pay something called PMI, which is they call it MI, PMI, but they call it private mortgage insurance. So anything under 20%, you're going to pay a PMI rate. It's a little different rate depending on the loan, depending on the amount of money down, depending on your interest or your credit scores. A lot that goes into that. But when we say it's insurance, it's not insurance for you. There's third parties that insure that, and they're taking a fee, a rate, if you would, and it's all different costs. So that can be a closing cost or into your down payment, potentially. VA loans are typically 100%. The VA will secure you. So again, that 100,000 number, you're going to finance 100% of it. So $100,000. So there's zero down. And next one is equity. Equity. So equity is, you buy that same $100,000 house, the appraisal comes in at $110,000. You got $10,000 in equity. How cool is that, right? That's fun times. I remember the very first house I bought, I think my wife and I paid $69,000 for it. It was in the foreclosure boom, late 2000s, and we paid $69,000. We refinanced it the following year for, I think, $115,000. And so that was kind of cool because now we had all that equity, right? And so we put a little bit into it, new kitchens, new bathrooms, refinanced it. All of a sudden, it was worth more. So equity. So that's when what you owe on it versus what it's valued at is your equity. So equity is great, right? When you pay down your loan, you gain equity. Inspection contingency. So inspection contingency is a contingency in the offer. When you present an offer, you have contingencies. Mortgages are contingencies. Inspections are contingencies. You can have an appraisal contingency. You can have a contingency on the sale of your own home. That can be a contingency. So some agents will say, hey, this is loaded up with contingencies, but home inspection contingencies, you can put in there, somewhere between 10 and 15 days is pretty common. There's no rule. You can do it in 2 days, but it's just tough to do. So, but you can do a home inspection. You can be done on wood destroying insect inspection, which is commonly called termites. Radon, contingent on a future use of the property. You say, hey, this is a duplex or this is a 4-unit. We want to convert it back to a house, or we want to take this house and chop it up and make it into multiple units. So you might be future use. So you might have to check with the municipalities on that. So you could have a contingent on that. You could have a contingent on obtaining insurance. And I pretty much always elect that for my clients because insurance, you don't know when you call your insurance company and they say, hey, there was past claims on this property that haven't been cleared. And then all of a sudden maybe they deem it uninsurable. It's pretty rare, but it's out there. And if you can't get insurance, that's a problem. The lender's going to not let you buy it if they can't get insurance. But if you do a cash buy and all of a sudden you can't get insurance, it's kind of not a good scenario. It also gives you the opportunity to check and see if it's in a flood zone. You might go, hey, this thing's on top of a hill. It's not in a flood zone for sure. Well, you still want to check because I have experiences where it was a larger parcel of property and part of the land did extend into a flood zone, even though the house was nowhere near there. So it's just things you want to check out when it comes to inspection contingencies. Radon, I think I mentioned radon. That's something that's pretty common. And but if you have a well or a septic, you might want to have a contingent on that. And there's some different clauses that surrounds that. So mortgages. What's a mortgage? Mortgage is, hey, that $100,000 that you were paying for the house, you are putting down 20%. So you had $20,000 closing or down payment. But the mortgage is for 80%. So 80,000, that's your mortgage. They're going to secure it. And you have to go through and, I'm going to use the slang of jumping through their hoops to get their money. They're going to ask for a lot of documentation to secure that mortgage. Mortgage rate. So mortgage rate, what's that? It's your interest rate, your mortgage rate. There's another thing. People, hey, what's an APR? Annual percentage rate. So why is the interest rate this and the APR that? Well, the APR is just a tool for you to shop lenders. So you can, in the old days, you'd get the newspaper out and you look at it and say, okay, and all the banks would, the different mortgages would show you, hey, here's our rate, here's our APR. Now you can compare them. So the interest rate is what the money's gonna cost you. But the APR is there's some additional expenses each lender, some fees, if you would. We're just going to use that word that they're charging to do the mortgage. There's some work involved there. So every bank kind of charges a little different rate, and so that's your comparison tool to compare the rate, compare the APR. Maybe somebody has a better rate but a lower APR. So you got to look at all those things. Then pre-approval letter. What is a pre-approval letter? So you called that lender that you just shopped the APR on, and you said, hey, I'd like to get pre-approved. They're going to check your credit. So you're going to give them permission to do that, and then they're going to say, hey, how much do you have for a down payment? And then they're going to check your accounts because you're going to verify that. And then you're going to go, hey, how long have you worked at your job? Give me your job history. Then they're going to say, hey, what's your income? And then they're going to check all of your expenditures. Your monthly expenditures have to go out compared to your income, and they're going to give you a debt-to-income ratio, and then they're going to approve you for a specific amount. They're not going to really. They do approve you for a purchase price, but really they're approving you for a monthly price, and then they can turn that into a purchase price. And so that's all the key terms I wanted to give you today. I did talk about PMI. That was something I wanted to hit too. So very good. Hope that was helpful for you. And if you would like to know any more information about what it would take for you to buy a home and how these key terms can come to life for you, right? And give me a shout and you can get on my website, find me there, nicksupik.com. Hope you're doing well. Have a blessed day.